When you initially start out, it could seem challenging to balance your duties while making rent and utility payments. You'll soon learn to master your monthly budgeting with a little trial and error. After accomplishing that objective, starting to invest is the next logical step, albeit this can also be the most difficult. As a result, we created this comprehensive tutorial on how to begin investing for beginners. You can obtain advice with investing on a tight budget if you need help getting started. You'll probably be asked a lot of questions about how much to invest from the moment you decide you want to start doing it. Where should I put my money to work? How much time? How exactly do I begin? There is often no right or wrong decision when it comes to investing, because the idea is not one size fits all. The amount of money, time, and danger you are willing to take will all affect your plan. In this video, we will discuss 10 steps that can help you start devising a plan. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 1. Learn your investment options. You need to be aware of the numerous available investment possibilities before you start investing. While by no means exhaustive, the list below includes some of the more usual alternatives you might run upon. Researching more complicated financial products might begin once you are familiar with the items on the list below. Here are 5 popular choices to help you decide before you start investing. Stocks. When you purchase stock, you essentially become a shareholder in the business. A single share of stock could cost anything from a few dollars to hundreds of dollars, depending on the firm you invest in. How much the stock fluctuates will depend on the firm's performance as well as the state of the economy as a whole. Bonds. Bonds are issued by corporations, states, or local governments for the benefit of individual investors. Bonds are commitments that investors must fulfill within a specified time frame. Investors will get interest up to that point, or until the bonds expire. Bonds are considered to be less dangerous because of these stringent standards. Exchange-traded funds. ETFs, or exchange-traded funds, are collections of individual investments. ETFs differ from mutual funds in that they are continuously traded. They are bought for a share price, just like stocks. ETFs can be a wise choice if you're just starting off and have a low spending budget. Since ETF share prices are frequently less than the minimal investment necessary for a mutual fund, they are more widely available. Real estate. Wall Street traders are frequently the first thing that springs to mind when the word investment is mentioned rather than real estate. Real estate remains one of the most lucrative and reliable sorts of investments, nonetheless. Maybe you're a young investor who avoids real estate because it seems expensive. The fact that you can use a loan to leverage a down payment to finance the purchase of a property is something that many people are unaware of. The basic steps for launching a real estate investing company have been laid out. Alternative investments. Assets that don't fit into the usual categories of investing, such stocks or bonds, are known as alternative investments. One example is real estate. One can have access to the worlds of venture finance, hedge funds, fine arts, antiquities, etc. through alternative investing. Because of the greater levels of risk and asset costs, high net worth investors frequently hold these assets. Number 2. Determine how much to invest. The amount you set aside is a crucial decision to make before you start investing. Working backwards is the most effective technique to figure out how much money to invest. Decide on the amount of investing success you want to achieve in the time frame needed to get there. The interest rates on your investments are something you should consider. After that, you can go back and divide your overall investment amount by a number of weeks or months. This stage is essential since it will enable you to more thoroughly assess your budget. Your chances of success can be improved by knowing just how much additional spending room you need to create in your budget. Dave Ramsey shares some terrific suggestions on how to cut the fat out of your monthly expenses so you can start investing much more rapidly. The recommendation is to invest 15% of your income. With regard to time and compound interest, this sum seems to give you the most momentum. This is especially true if you're trying to save money for a significant purchase, such as college or a mortgage. Number 3. Start investing in a 401k. To save enough money for retirement is a frequent financial objective for many people. You ought to take part in any retirement plan your employer offers, typically a 401k. You may be able to start saving money for retirement through a specific sort of plan called a 401k that your employer may offer. Regular payroll deductions allow you to donate a certain percentage of your earnings. The money used for this donation was pre-tax. If you're fortunate and reach a certain minimum, your employer may additionally match a percentage of your donation. Considering that this is free money, be sure to accomplish that goal. Experts advise allocating 10 to 15% of your yearly salary to retirement savings. Number 4. Open an investment account. You shouldn't be concerned if your place of employment does not offer a 401k. Private retirement savings options are offered by many reliable financial firms. Individual retirement accounts, or IRAs, are the name given to these funds. You can prevent paying taxes on retirement withdrawals by paying taxes on your contributions now with a Roth IRA. Don't immediately throw out a Roth IRA as a second investment choice if you already have a 401k. For instance, your company might decide to set your 401k deduction at 7%. Remember that you should save no less than 15% of your income for retirement. As a result, you still have 8% available for investments. Why not allow your money to grow tax-free? Number 5. Choose your investment strategy. It's time to choose your investing strategy now that you are aware of some of the most popular investment possibilities. What are you trying to save for? We return to these queries. How much money is necessary to make that happen? How long do you anticipate it taking you to accomplish that goal? You'll start to discover how aggressive or conservative you can afford to be based on your responses to these questions. For instance, you'll probably have a few decades to put your money in long-term equities and mutual funds if you reach your retirement savings goal. But what if you want to achieve something in the following years? You shouldn't invest all of your money in long-term holdings in this situation. Saving money in a high-interest savings account where it will still be accessible can be preferable. You may make the best investing decisions much more quickly and simply by chatting with a financial counselor. Number 6. Work with a financial advisor. If you want to work with a pro, there is not the least bit of shame in your game. It is strongly advised that you start by carrying out this. You'll have a lot of questions because investing is complicated. You can make the best judgments with the assistance of a seasoned financial professional. It's a fantastic technique to find fresh methods and investment chances. You'll soon feel a lot more skilled and confident once you start investing on your own. Number 7. Start investing early. Gaining wealth requires a lot of time. The longer your money has to grow, the longer it will be invested in stocks and other assets. However, some financial professionals advise putting emergency fund creation and debt payback ahead of time. You cannot invest money or put money aside for the future when it is being used to pay off debt. If we are not ready, we are all just one emergency away from going bankrupt. As a result, priority should be given to these two things before investing. This will ensure that you can invest as much of your money as you can while providing a safety net to catch you if you fall. Number 8. Be willing to learn. Although forecasting the market is difficult, one thing is for certain: it will be volatile. It takes a lot of time and incremental study to become an effective investor. The market will occasionally prove you wrong. Accept that and use it to your advantage. Number 9. Build your investment portfolio. The next step after deciding to start investing is to start putting together a portfolio. An assortment of investments is referred to as a portfolio. A stockholder may own a variety of equities in their portfolio. A different investor might own a combination of mutual funds, ETFs, and stocks. There is no correct or incorrect response. The composition of one investor's portfolio will be very different from another's. This is accurate because everyone has different financial objectives, time restraints, and risk tolerance. However, it is advised that you find a balanced combination of various assets, particularly at first. You lower your risk by doing this. Spreading out your investments will prevent you from investing all of your money in one place. Number 10. Be in it for the long term. Sticking with the finest long-term strategy might not be the most interesting financial choice. However, your chances of success should increase if you persevere and refuse to give in to your emotions or false pals. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.